All right, let's dive in for another deep dive.
Looking forward to it.
This time we're tackling excerpts from Benjamin Graham's The Intelligent Investor.
The revised edition.
Oh, right, the revised edition, which, it's a classic for a reason,
Absolutely.
and we're going to kind of try to condense it down to the core ideas of intelligent investing.
Sounds good.
So right off the bat, Graham really stresses the importance of being an intelligent investor.
Mm-hmm.
And this isn't about, striking it rich quick or chasing the latest trends or anything like that.
Right.
He actually defines it as an operation that promises safety of principal and an adequate return.
Yeah, it's all about making sound decisions based on solid principles,
Yeah.
really equipping yourself to navigate any market, no matter how crazy things get.
And he breaks it down into three core elements: thorough analysis, protection against losses, and focusing on adequate, not extraordinary returns.
Right, so it's not about swinging for the fences with every investment.
Yeah, so we're not trying to, build a skyscraper overnight.
Exactly, it's about building a solid foundation, like you said.
Gotcha. So thorough analysis, what does it really mean?
It means understanding the businesses you're investing in, really digging into their financials, and assessing their long-term prospects.
It makes me think about that story about Sir Isaac Newton and the South Sea Bubble,
Oh, yeah.
where he lost a fortune. Even, brilliant minds can fall prey to the hype.
Yeah, it's a perfect illustration of Graham's point. Newton, despite his genius, got caught up in speculation and ignored all the warning signs.
Yeah.
Intelligent investing is about discipline, research, and not just blindly following the herd.
So how do we avoid those mistakes? Well, Graham introduces this really interesting concept of Mr. Market.
Yeah.
Who's this fictional character who really represents the emotional swings of the market?
Mr. Market's that unpredictable friend, right?
Right.
He's either overly optimistic or incredibly pessimistic. And he's always offering to buy or sell your investments at prices that fluctuate wildly because of his moods constantly changing.
So how do we deal with this, erratic character? How do we not get swept up in his emotional roller coaster?
Don't let his mood swings dictate your decisions, right?
Yeah.
Focus on the intrinsic value of your holdings. What are those companies really worth based on their fundamentals?
Right.
If he's offering a price way below, it might be a buying opportunity.
Yeah.
If he's offering a price way above, it might be time to consider selling.
Yeah, that makes sense. It's like, finding a great deal at a store when things are on sale. You're
Exactly.
taking advantage of a temporary price drop.
Mm-hmm.
Now, Graham, he talks about two main types of investors,
Yeah.
defensive and enterprising. So what's the difference?
Well, he recognizes that investors have varying levels of knowledge, experience, and risk tolerance. So a defensive investor really prioritizes safety and simplicity, while an enterprising investor is willing to put in more time and effort for potentially higher returns.
So a defensive investor might be someone who doesn't have a ton of time to dedicate to managing their investments.
Exactly, yeah. They might opt for a straightforward approach, like a diversified portfolio split between stocks and bonds,
Okay.
which gives them a nice balance of growth potential and stability.
Makes sense. And then what about on the bond side of things? There's so many different types of bonds out there.
Well, for the defensive investor, safety and quality are key.
Yeah.
So Graham suggests sticking with bonds that have those three highest ratings, the
Never heard of
AAA, AA, and A,
Okay.
from agencies like Moody's or Standard & Poor's.
Okay.
And he also says to consider, your tax bracket when choosing between taxable and tax-free bonds.
Oh, interesting. So it's not just about the yield, but it's about how much I'm actually going to, keep after taxes.
Precisely. You have to calculate that after-tax return to make the smartest choice.
Now, let's talk about stocks. Graham, he cautions defensive investors against getting caught up in the allure of those growth stocks.
Right, the ones that everyone's raving about, promising those sky-high returns.
Right, exactly, exactly.
But those promises often come with, a big dose of risk.
Yeah?
For a defensive investor, it's much more prudent to seek out large, prominent, financially stable companies
Okay.
with a history of consistent earnings and dividends.
So kind of like the blue chip stocks, like
Eh.
the ones that have weathered the storms, yeah.
You got it. Those are the companies that you can generally rely on for stability and steady growth over the long term.
And he also mentions looking for companies that are selling below their historical average price
Mm-hmm.
and their historical average price to earnings ratio, or PE ratio.
Mm-hmm.
So what is that exactly? And why does it matter?
It's a key metric, basically, that tells you how much investors are willing to pay for each dollar of a company's earnings. So a lower PE ratio could indicate that a company is undervalued by the market.
So it's kind of like we're finding those hidden gems that other investors might be overlooking.
Exactly. And that's really core to Graham's philosophy. He's all about finding value, not chasing hype.
Now let's shift gears a little bit and talk about enterprising investors. What kind of advice does Graham offer to those who are willing to take on a bit more risk?
Well, he acknowledges that enterprising investors can venture into a wider range of securities and potentially reap higher rewards, but he emphasizes that thorough research and applying those business standards to your investment decisions are still non-negotiable.
So we're not just, throwing darts at a stock board.
Definitely not, no. It's about finding those diamonds in the rough. Undervalued companies with good growth prospects, even if they've experienced a recent setback or operate in an industry that's currently out of favor.
So I'm sensing a theme here.
Yeah.
It's all about doing your homework and making informed decisions.
Absolutely.
No matter what kind of investor profile you fall into.
Right. Graham was writing in a different era, but his emphasis on thorough research and understanding the businesses you're investing in, I think it's even more crucial today.
Especially with all the information overload that we have,
Exactly, yeah. It's so easy to get caught up in all the noise and, make these impulsive decisions based on headlines or social media trends.
Yeah.
But Graham, he reminds us that intelligent investing is about cutting through the clutter and focusing on those fundamentals.
So before we move on to part 2,
Yeah.
What's one key takeaway you want our listeners to remember from this first part of our deep dive?
Remember that intelligent investing is not about speculation or gambling. It's about making informed decisions based on solid research, managing risk, and understanding those businesses you're investing in.
Yeah.
Whether you're a defensive investor seeking stability or an enterprising investor looking for higher returns, those core principles remain constant.
That's a great point to keep in mind as we delve further into Graham's wisdom.
Absolutely. So one of the things Graham really warns against is the allure of those high growth companies, especially those with those sky high price to earnings ratios.
Mm-hmm.
He uses Chrysler between 1952 and 1970 as a cautionary tale.
Chrysler, oh yeah. Wasn't that the example where the stock price was like all over the place, even though they had these moments of really strong earnings growth?
Exactly, yeah.
Yeah.
Their stock price was incredibly volatile during those years. It would soar when earnings were up, then plummet when growth faltered.
Right.
And Graham uses this to illustrate how relying solely on earnings growth to pick stocks can be, misleading and even dangerous.
So even if a company is growing really fast, it doesn't necessarily mean it's a good investment.
Right.
There's more to it than just, looking at that single metric.
Absolutely, yeah. Those high PE ratios that often accompany high-growth stocks, they can actually magnify your losses if that growth isn't sustainable.
Yeah.
When the inevitable slowdown occurs, the stock price can fall dramatically.
It's a reminder that investors often get overly excited about growth and end up paying a premium for it.
Right.
And then when that growth doesn't meet expectations, the price correction can be pretty painful.
Yeah, for sure.
Yeah. So that's why Graham emphasizes the importance of, looking beyond the hype and really digging into those underlying fundamentals of a business.
Absolutely.
Now, for enterprising investors who are willing to do that homework, Graham suggests an interesting approach.
Okay.
Seeking out what he calls bargain issues, and in particular those net current asset stocks. And we touched on this a little bit earlier.
Yeah.
But these are companies whose stock price is trading for less than the value of their current assets, minus their liabilities.
That's right. Yeah.
So you're basically, buying $1's worth of assets for less than $1.
Exactly.
Which gives you a built-in margin of safety.
Yeah.
He even cites this 1957 study that showed some pretty impressive returns from this strategy.
Wow. So are these opportunities still out there in today's market?
Well, finding those net current asset situations, it can be more challenging today.
Okay.
Information is, it's more readily available.
Right.
And investors are, quicker to spot and capitalize on those undervaluations. But they do still exist.
Okay.
Often in industries that are, out of favor or overlooked by the mainstream.
So you got to do a little more digging and be willing to venture beyond the well-trodden paths.
Precisely.
Yeah. Okay. Interesting.
It's really a strategy for that enterprising investor.
Yeah.
Who's willing to put in the time and effort to uncover those hidden gems.
And this is where Graham's emphasis on thorough financial analysis comes in.
He really dedicates a significant portion of his book to walking readers through those essential financial ratios and metrics that can help you assess a company's health.
Yep.
I mean, he even provides specific examples of companies he analyzed.
Yeah.
Even includes like these detailed tables with their financial data.
Right.
It can be a bit dense at times, I got to say, but it really drives home the importance of understanding a company's financial position before investing.
He's not just handing you a fish, he's teaching you how to fish, right?
That's right.
He's empowering investors to make informed decisions based on their own research and analysis, not just relying on the opinions of others.
It's a stark contrast to the way a lot of people approach investing today, where decisions are often driven by headlines or social media trends.
For sure.
Graham emphasizes a much more rigorous, research-driven approach. Now, let's talk about mutual funds. They've become incredibly popular since Graham's time.
They have?
What's his take on them?
Well, he dedicates a whole chapter to mutual funds.
Oh, wow.
Which is really fascinating considering how much smaller the industry was back then.
Yep.
He analyzes their performance, compares them to other investment vehicles, and even delves into the track records of individual fund managers.
Interesting. So what are some of his key observations? Does he think mutual funds are a good option for investors?
Well, he expresses some skepticism about the ability of most fund managers to consistently outperform the market.
Okay.
He points out that after accounting for fees and expenses, many funds actually underperform.
Oh, wow.
Compared to simply investing in a broad market index.
And this was, before the rise of index funds, which have become such a popular choice for investors seeking that, low-cost, diversified approach. What do you think Graham would think of those?
Given his emphasis on minimizing costs and his skepticism of active management, I think he would appreciate the simplicity and efficiency of index funds for sure.
Yeah, they align pretty well with his philosophy of seeking a reasonable return without taking on excessive risk.
That's right.
He even includes tables in the book showing the performance of various mutual funds from the 1960s.
Yeah.
It's a reminder that past performance doesn't guarantee future results. And chasing hot funds can be a recipe for disappointment.
Exactly. It reinforces that investing is about making those sound decisions based on solid research. Not just following the latest fads or trends.
Graham also delves into the relationship between shareholders and management. And he actually advocates for a more active and engaged role for shareholders. He encourages investors to, hold management accountable. Demand clear explanations for, disappointing results.
Right.
And even consider electing, independent directors to the board.
He's emphasizing the importance of viewing yourself as a part owner of the business.
Right.
Not just a passive holder of stock certificates.
And he even challenges, the prevailing views on dividends at the time. Arguing that companies should really prioritize returning cash to shareholders through dividends rather than hoarding it or engaging in acquisitions that might not create value.
His perspective on shareholder activism and dividend policy, it might seem a bit unconventional, but it really underscores his commitment to making sure that companies are acting in the best interests of their owners, shareholders.
Right. And this brings us back to his central concept of margin of safety, which he describes as the cornerstone of intelligent investing.
He emphasizes that this margin of safety comes from buying stocks at a price significantly below their intrinsic value,
Okay.
which provides a buffer against potential losses,
Uh-huh.
even if your assumptions about a company turn out to be wrong.
And he even uses a mathematical example
Mm-hmm.
to illustrate this concept,
Right.
calculating that over a 10-year period, the typical difference between the earning power of stocks and the interest rates on bonds provides this built-in margin of safety.
Yeah, but he cautions that this margin of safety can be eroded
Right.
if investors overpay for stocks,
Okay.
especially in a market where prices are inflated.
So it's not just about finding, undervalued companies. It's
Mhm.
about making sure you're not overpaying,
Right.
even for companies with, seemingly strong growth prospects.
Precisely. The intelligent investor needs to be, disciplined and patient,
Yeah.
waiting for those opportunities to buy stocks at a price that offers that sufficient margin of safety.
Mhm.
He reminds us that that risk is not inherent in the market itself,
Okay.
but rather in our own decisions as investors.
I love how he frames it.
Mm,
He says, the risk is not in our stocks, but in ourselves.
that's good.
It's such a powerful reminder that our own emotions and biases can often lead us astray.
Right.
Yeah.
And he even provides a practical tool for managing those emotions.
Okay.
He creates this investment owner's contract
Oh, interesting.
where investors can pledge to themselves that they'll avoid making impulsive decisions based on market swings or emotional reactions.
Oh, that's interesting.
Mhm.
It's almost like setting those boundaries for your own behavior,
Right.
creating a set of rules to guide your investment decisions.
Exactly. It's a way to stay grounded in those core principles of intelligent investing, even when the market gets crazy.
I'm eager to hear more about how Graham's ideas have influenced some of the most successful investors of all time,
Okay.
particularly Warren Buffett.
Well, that's a great segue to the next part of our deep dive,
Okay.
where we'll explore the remarkable track records of those who have followed in Graham's footsteps and achieved some extraordinary results by adhering to his timeless principles.
It's really incredible to think about the lasting impact Benjamin Graham has had on the investing world.
Yeah, his influence is undeniable.
He didn't just write a book. He really shaped the way countless people approach investing.
For sure. And you see it not just in, Warren Buffett's success, but in the strategies employed by value investors all over the world.
And in the revised edition of The Intelligent Investor, Buffett actually dedicates an entire appendix
Wow.
to showcasing investors who followed Graham's principles and achieved phenomenal returns.
Really?
Yeah, he calls them the super investors of Graham and Doddsville.
That's a great title.
Yeah, right.
It is.
And it's really a fascinating read.
Yeah.
He highlights 9 different investors,
Yeah.
all with their own unique styles,
Mm-hmm.
but all kind of anchored in those core tenets of value investing.
Right.
And they consistently outperform the market,
Yeah.
not by luck,
Right.
but by being disciplined, patient, and laser focused on finding value.
You weren't swayed by market trends or the latest, hot stocks.
No.
They stuck to their principles and let their investments, compound over time.
And what's really striking is the diversity of their approaches.
Mm-hmm.
Some focused on small companies, others on large ones.
Yeah.
Some had concentrated portfolios, while others were more diversified.
Right.
But they all shared that fundamental belief in buying businesses, not just ticker symbols, and in seeking that that margin of safety. So it really reinforces the idea that Graham's principles are adaptable.
Yeah, for sure.
You can apply them in a way that suits your own risk tolerance, your goals, and your time horizon.
Exactly. Buffett intentionally highlights this diversity to dispel the myth that there's only one right way to be a value investor.
Right.
As long as you're grounded in those core principles,
Yeah.
Thorough analysis, margin of safety, and long-term thinking.
You can find success in a variety of ways.
Exactly.
It's pretty inspiring, wouldn't you say?
It is, yeah. It shows that anyone, regardless of their background or expertise, can learn and apply these principles.
And it's not just about making money,
Right.
Graham emphasized the importance of ethical behavior, of acting with integrity,
Mm-hmm.
and treating your fellow investors with respect.
That's right.
For him, intelligent investing was about about building a better financial future for yourself and for society as a whole.
It's a really crucial point. He saw investing as a way to participate in the growth and prosperity of businesses, to share in their long-term success. He wasn't about, quick profits or taking advantage of others.
It's a refreshing perspective, especially in a world where, short-termism and greed often seem to dominate the financial markets.
He reminds us that investing should be about building something lasting, something that benefits not just ourselves, but also the companies we invest in and the broader economy.
Yeah.
It's about creating value, not just extracting it.
Yeah. But we've covered so much ground today, from the core principles of intelligent investing to the remarkable track records of those who've followed Graham's path.
Mm-hmm.
It's clear that his wisdom remains as relevant as ever.
Absolutely. Even after this deep dive, I feel like we've only scratched the surface.
I know, right?
Yeah. The Intelligent Investor is a book you can return to again and again, throughout your investing journey.
Yeah.
And always discover new insights.
I know, I'll be revisiting it soon. It's just, it's packed with so much wisdom and practical advice. But as we wrap up, what's one key takeaway you'd like to leave our listeners with?
I'd say remember that investing doesn't have to be this confusing or risky gamble.
Yeah.
By understanding and applying Graham's principles, thorough analysis, margin of safety, long-term thinking, and ethical conduct.
Anyone can become an intelligent investor.
Exactly.
And build a solid financial future.
That's right.
That's a great reminder.
Mm-hmm.
And to add to that, don't be afraid to think for yourself.
Right.
Do your research, question assumptions, and don't blindly follow the crowd.
That's right.
As Graham taught us, the risk is not in our stocks, but in ourselves.
Well said. Be intelligent, be informed, and be in control of your own investments.
Thanks for joining us on this deep dive into The Intelligent Investor. Wow. Until next time, happy investing.